The company that owns every phone tower in America makes billions of dollars a year, and it has almost nothing to do with phones. Here's the number that should stop you cold. American Tower Corporation generated $10.14 billion in revenue in 2025. Adjusted earnings before interest, taxes, depreciation, and amortization of $6.46 billion, and net income of $2.2 billion. And it did all of that while building almost nothing new. It manages roughly 225,000 communication sites across the world, making it the largest independent tower operator on the planet. And it doesn't sell phones, doesn't sell service plans, doesn't have a single retail store you've ever walked into. It sells air. Specifically, it sells the right to hang equipment on a steel structure it already built years ago to the exact same three carriers over and over again for decades. By the end of this, you'll understand why owning the empty space on top of a pole turned out to be one of the most quietly dominant business models in the American economy. Start with the mechanism, because it explains everything else. A cell tower company builds one physical structure, then leases small sections of that same structure to multiple wireless carriers at the same time. Verizon rents a slice, AT&T rents a slice, T-Mobile rents a slice. All three are paying rent on the exact same pole, and here's the part that makes the entire business model work. The cost to build and maintain that tower is largely fixed. Concrete, steel, land, a security fence. None of that gets meaningfully more expensive whether one carrier is using the tower or four are. But every additional tenant added to an existing tower carries almost pure profit because the incremental cost of hanging one more carrier's equipment on a structure that's already standing is small compared to the fixed cost of building the site in the first place. This is the exact mechanism, straight from the company's own investor materials, that Tower REITs describe as operating leverage. And it's the single idea that explains why this business gets more profitable, not less, every time a new carrier signs on to a tower that already exists. Now look at how the contracts are actually structured, because this is where the guaranteed, boring cash flow comes from. Leases with major carriers typically run 5 to 10 years, with multiple renewal options built in, and almost none of them are cancelable early. On top of that, contracts usually include an escalator clause, meaning the rent automatically increases every year, tied to a fixed percentage or a consumer price index figure, whether or not the tower company does anything at all. The industry even has a specific vocabulary for how this revenue moves. Colocations and amendments describe new tenants signing onto an existing site or adding new equipment to a lease they already have. Escalations describe those automatic built-in rent increases. Churn describes the rare case where a tenant actually leaves. In 2025, property revenue made up the overwhelming majority of American Tower's total revenue, and the company's own quarterly disclosures show that as of a recent quarter, property operations accounted for $2.53 billion of a total $2.63 billion in revenue. This isn't a company selling a product. It's a company collecting long-term, automatically escalating rent on physical structures it already owns, from tenants who have almost nowhere else to go. Here's the part almost nobody outside the industry understands about why competitors can't simply undercut this business by building more towers. In most markets, once a carrier has three towers within range of an area, adding a fourth tower barely improves coverage, but it does add an entire new fixed cost. Zoning approval alone can take months or years in dense American markets. Land leases have to be negotiated individually with often reluctant landowners, and federal, state, and local permitting adds its own separate timeline on top of that. So instead of building competing infrastructure, carriers overwhelmingly choose to lease space on towers that already exist. The tower company isn't really competing on price. It's sitting on a scarce, already built, already permitted piece of vertical real estate that would take a rival years and enormous capital to replicate, and every year that passes without new competing supply, the leverage sites more firmly with whoever already owns the tower. But this business isn't invincible, and the industry's second largest player just proved it in dramatic fashion. Crown Castle spent years building out not just towers but also fiber optic cable and small cell networks, betting that bundling all three together would create a broader, more defensible communications infrastructure company. Instead, the fiber and small cell businesses turned into a drag. Crown Castle faced Sprint-related lease cancellations after T-Mobile's acquisition of Sprint eliminated a major tenant, an ongoing payment dispute with EchoStar and Dish Wireless, and a level of activist investor pressure from Elliott Investment Management so intense it triggered a full executive turnover, with one chief executive terminated and an interim leader installed before a permanent replacement finally arrived in September 2025. In 2025, Crown Castle cut its annualized dividend from $6.26 to $4.25, a cut of roughly 32%, and income-focused shareholders who had bought the stock specifically for that dividend exited in large numbers. The company's answer, finalized on May 1st, 2026, was to sell its entire fiber solutions business to Zayo for $4.25 billion and its small cell business to EQT's Arium Networks for another $4.25 billion, $8.5 billion combined, using the proceeds to pay down debt and refocus entirely on the one part of the business that had never actually been the problem: the towers. Crown Castle didn't get punished for owning towers. It got punished for wandering away from the one business inside its portfolio that had operating leverage baked directly into the physical structure and chasing growth in businesses that didn't. So here's the final balance sheet, collapsed into one sentence: a fixed-cost physical structure that gets more profitable with every additional tenant, locked into long-term, automatically escalating leases with carriers who have almost no incentive to build a competing tower next door, has turned cell tower ownership into one of the most quietly dominant recurring revenue businesses in the American economy. And the moment a company wanders away from that core mechanism chasing something flashier, the market punishes it immediately and specifically. American Tower didn't get to 225,000 sites by selling anything you'd recognize. It got there by owning the one piece of infrastructure that Verizon, AT&T, and T-Mobile all need at the exact same time in the exact same place, and by understanding that the emptiest, most boring asset in American telecom, a steel pole standing in a field, was actually the only piece of the entire wireless industry that no carrier could afford to live without.